Good afternoon. Welcome to another LBMA webinar. Today we have another episode in our digital gold series. So this is part 3, and we're going to be talking about gold and Bitcoin and how the two of those combined can enhance risk-adjusted returns. I clearly know not enough about this, so I'm going to hand over to Sakhila Mirza, who will host Charlie Morris and James Butterfill. She will do their introductions properly when I hand over to her. But before I do, I just want to take you through a quick housekeeping slide. So this is about questions, because if you're anything like me, you've got a few questions about Bitcoin. You can ask these using the Q&A function at the bottom of your screen. If for some reason you can't access this, can't see it, can't use it, not a problem. Just email us at ask@lbma.org.uk. You're also more than welcome to send questions through this after the webinar if something jumps out at you after you've listened to it. So those are the ways you can email us your questions, and obviously we'll hand those across to the panelists and get back to you. So without further ado, let me hand over to Sakhila. So Sakhila, whenever you're ready.
So thank you everybody for joining this webinar. It's Digital Gold Part 3. For those who were unable to tune into the first 2 parts, we were focusing very much on digital gold. So gold as a digital asset. I would encourage you to listen to those webinars, because those were asking questions along the lines of, will digital gold ever be a success? And our panelists generally were of the view that time was needed before digital gold became more popular. But today, we're not talking about that. We're talking about perhaps the most popular digital asset, and that's Bitcoin. I do believe Bitcoin needs no introduction. There's been a lot of media coverage recently discussing the price of Bitcoin. There's a lot of hype around Bitcoin. And I'm delighted to be welcomed, and I'm delighted to be joined by Charlie Morris and James Butterfill, both experts in this space, and both to help me sort of navigate and understand a little bit more about Bitcoin, but also Bitcoin and the relationship with gold, because again, there's been a lot of media coverage. Charlie Morris is the Chief Investment Officer at ByteTree Asset Management, with over 23 years in fund management. And James Butterfill has also over 20 years in traditional finance and has recently joined CoinShares as their investment strategist. So thank you to you both for joining us. And for our audience, I just want to highlight, please do send in our questions, any questions you may have. I want this to be interactive. So let me start then with the first question. It's a very open question. Let's start with mainly firstly on Bitcoin. I mean, we've heard Bitcoin's reached new records this year at over $50,000 US. A year ago, it wasn't even at $10,000 US. So just wanted to sort of hear your views on Bitcoin as an asset class. What's driving that value? Where is it coming from? And just sort of understanding what your perspective is on Bitcoin before we move on to talking about gold. So Charlie, would you like to start?
Yes, thank you, Shakira. Bitcoin is a fascinating one. It's now 12 years old. It's got the world's attention 3 times now, in 2013, in 2017, and in the last couple of months. And it really is growing up. The difference this time is that the institutional investor has arrived. Now, the institutional investor turned up for the first time in small size in 2013. Their interest in the space has been pretty insignificant until recently. I would suggest that about 10% of inflows into the Bitcoin space were institutionally driven until the middle of last year. Something changed around October time. We could talk about that as well if you like. And suddenly they are the dominant buyer of Bitcoin. And that really is the new story. And I'm sad to say some of the money that's gone into Bitcoin has come from the gold market.
James, did you have a view?
Yeah, Bitcoin, I think, is best described as a non-sovereign store of value with, I suppose, a growth component and a diversification component. And it has lots of other interesting features, I think, that set it aside as its own asset class, such as it's programmable. It has very high fungibility, very low transfer friction. And I think and it also represents as an investment ownership in a peer-to-peer monetary ledger system, which I think really sets it aside from, if you think about asset classes, it's a group of assets with similar characteristics. That's how you probably define them. and I think Bitcoin probably and other crypto assets probably warrant their own asset class for that. And over the last year, I think we've seen a slow realization of investors, that slow having had many client calls over the last 9 months discussing with clients. And actually, when I was at ETF Securities, we were talking about Bitcoin 4 years ago. Huge amount of ridicule from clients there. I think that's generally the first kind of phase in people trying to understand Bitcoin. And as you start to look more deeply into it, and that I think does take some time because it's not an easy concept to understand. But as that sort of understanding progresses, people's views and opinions start to change. And as Charlie said, yeah, I think we saw a lot of people post-COVID really start to think deeply about Bitcoin and see that it was a very hard asset. And I just mentioned Tyler Winklevoss, and I think I'll read out what his quote was. He said, "We have elected to put our money and faith in a mathematical framework that is free of politics and human error." And I think that's a really, really good summary of Bitcoin, what it represents. It's something that's mathematically beautiful, very well thought out concept, and is potentially one of the hardest assets in existence.
Thank you. Then let's quickly move on to what I'm sure most of our participants would like to understand a little bit better in terms of the relationship between Bitcoin and gold. Is there a relationship? Again, the media has been covering quite a lot in terms of will Bitcoin be replacing gold as a hedge against inflation? Is that likely? Where do you see in terms of a portfolio? Should it have? Should you be replacing gold with Bitcoin? Or can they coexist? Charlie, let's start with you.
Well, to carry on from James, I mean, I first wrote that Bitcoin was a new asset class in 2013, and people looked at me strangely at the time. And I think it really is a new asset class. And so, gold is the king of commodities. It's the one with the large supply and the one with a lot deep rooted in our history. Bitcoin's come along designed around the idea of gold on the supply side. So both gold and Bitcoin have a fixed supply. They're both outside the financial system. Neither pay a yield. Let's not talk about DeFi at this moment in time, but in their simplest form, neither pay a yield. And because they're different asset classes, they do behave differently. Now, where do they have something in common? Well, Bitcoin's returns over the last decade, 95% of them have coincided with risk-on market conditions, which would be bond yields flat or rising and inflation expectations flat or rising. So when we've had a big risk-off event, for example, in March 2020, or had Bitcoin been around in 2008, which it wasn't, it wouldn't have liked that environment very much. And there's some similarity with gold there, except that I see gold as a risk-off Bitcoin, and I see Bitcoin as a risk-on gold. And so they both hedge against inflation in the long term. But if you hold the two together, you get that natural portfolio balance. A bit like you get that natural portfolio balance between owning bonds and equities in the old days. Obviously, bonds have lost their status because they don't yield very much anymore. So we've got to think differently going into the next decade. But because the bond market's not there to save us, and so you've got this idea that we think that the expansion of the balance sheet is going to create inflation. Some people, I think the standard Wall Street, City of London view is that inflation is temporary. It's going to come with a recovery, and then it will fade away. I don't take that view. I think it's structural. I think we're going to a 1970s type higher inflation environment. Gold's going to be extremely relevant. So is Bitcoin. One's risk on, one's risk off. Put them together, then you get the best of both worlds.
Yeah, and I would, I mean, if I had a couple of $1 billion and I decided to reprocess all the gold mine tailings around the world, I could probably get quite a lot of gold at a fairly relatively cheap price. And I could theoretically flood the market with that gold and influence the price. I think what's really interesting with Bitcoin is if you did the same, you spent a couple of $1 billion on mining equipment, started mining a lot of Bitcoin, it has a difficulty adjustment, which has a sort of trailing 2-week adjustment timescale on it. So if there was suddenly a whole load of new mining equipment to come online, the difficulty adjusts to ensure that the supply remains at a very steady level. So the supply, I think for gold is fairly predictable, but it's almost perfectly predictable for Bitcoin. And I think that's what makes Bitcoin almost a harder asset. But aside from that, I don't think there's a huge amount of difference between gold and Bitcoin. Certainly, if you think about it from an inflationary perspective, something that is a hard asset is something that's priced in dollars that has a fixed supply. And I think you could argue, for the most part, gold and Bitcoin have that. And therefore, they do. And certainly, if you look historically over the last 4 or 5 years, there's been an improving relationship with Bitcoin and inflation, and there is an existing relationship between gold and inflation. So I do think they have a lot of similarities. Now, we've seen a little bit of discrepancy in recent months with gold fund flows and Bitcoin fund flows. They seem to be operating in a completely opposite manner, and it may be in the short term that Bitcoin is cannibalizing gold flows a little bit, but I think conceptually that doesn't make sense for the longer term, and I don't think that sort of trend will matter too much. But just adding to the point that Charlie made, there's a really interesting, CoinShares have created an index. You can find it on Bloomberg. It's called Coin CGCI Index. And it's a very simple metric where you take gold trading 180-day vol, and you take the top 5 cryptocurrencies 180-day trading vol, and it's a risk parity weight adjustment essentially. And what you end up getting, and you can do this with Bitcoin alone, by the way, but what you end up getting is something with considerably less drawdowns than Bitcoin on its own. Drawdowns on Bitcoin over the last 3 years have been around 83%. Combined with gold, those drawdowns on a risk parity basis, the drawdowns would only been 26%, which interesting is a lot less than equities over that time period. So it might be a good way for that combination of the two, a good way for people to dip their feet into the markets if they're a bit worried about going sort of full bore Bitcoin.
So do you mind, Sakhila, since James stopped for a commercial break there, if I do the same? So ByteTree Asset Management also has a strategy called Bold. So Bitcoin plus gold equals Bold. And to not take the top five cryptos, but just Bitcoin, the king in the room, and gold, with the king of all commodities, the king of all precious metals, to put them together, use a 360-day realized volatility. And an inverse volatility weighting mechanism, you end up with a security with less volatility than Microsoft, with lower drawdowns than massively lower than Bitcoin, and pretty much the same as gold itself, but a nice pickup. I think this really is the whole Bold or CoinShares CG. I beg your pardon.
CGCI.
Whatever. Bold's easy to remember, isn't it, ladies and gentlemen?
Yeah, that's right.
This is the way forward. I think this is how the space comes together. To put into perspective, a risk-weighted strategy would typically give you 20% in Bitcoin over time, 80% in gold. And when Bitcoin's at its most volatile, that drops to 10, maximizing to about 30 when Bitcoin's at its calmest. Now, going forward 20 years or so, if Bitcoin does become gold, that means its long-term volatility has got to go from being typically above 60% to typically below 20%, which is where gold is. Bitcoin can get there, but it won't do it with hype cycles that we're seeing at the moment.
So Charlie, I mean, you just made the comment, if Bitcoin becomes gold, do you think that's likely?
Well, no, because it's different. It's a different asset class. I think that people haven't thought about it that clearly. Think that they're trying to replace gold as if there's a need to. There isn't a need to. I mean, there are a number of things that gold has. One is a deep-rooted financial network in the old world of finance, and that's huge, by the way. That's the world's central banks and so on. Bitcoin is an idea that is among many other things trying to replicate that. Their similarity in design is by design. So Satoshi Nakamoto designed Bitcoin with a supply profile very similar to gold, and that is to tend towards zero over time. Now we can get into the nuance of that, because eventually they stop mining Bitcoins. In fact, it's only in 20 years they don't mine many Bitcoins, and then it really tails off to virtually nothing. But the miners still need to exist, and they still need to collect fees. And the same way that, you know, scrap metal, scrap gold comes back to market, and we put it into the supply side of the equation, you have to wonder whether Bitcoin mining fees should be treated as a secondary market cost, which obviously they are, although they have similarity with scrap in some way. The big difference between gold and Bitcoin, if they're very similar on the supply side, is the demand side. And they're poles apart.
And what do you think makes them poles apart on the demand side?
Well, Bitcoin comes with gold with a tech story on top. So the idea is that you can use Bitcoin with applications which could potentially challenge the financial system in so many ways. Now, Bitcoin's expensive to transact. It's cheap to trade with a broker in an exchange or something, but very cheap to trade. But it's expensive to trade online in small size. You know, the average transaction fee is really not suited to micropayments, for example. But that doesn't matter, because you can take your $1 billion of Bitcoin or your $1 million of Bitcoin, lodge it in an electronic vault, use it as collateral, and once that's done, you can build a financial system on top of that, using what's happening in DeFi today in the space, in the digital space. And that could include the ability to send fiat currency around the world at practically zero cost, to open up an insurance market, a lending market, you name it. You can basically replicate the entire financial system on top of the Bitcoin network, and that's the bull story on top of the Bitcoin's the new gold story.
I mean, I would add that there are technologies starting to come about now, such as the Lightning Network, which overlays the Bitcoin network, which will enable Visa equivalent, at the very least, transaction speeds. And I think there's lots of, the interesting thing about gold is it does have this store of value identity at the moment, but there are lots of other identities in the future that it could take on, and one of these is a fast payments network. Now, that's not proven yet, and I think gold's main utility at the moment seems to be a store of value, but there are lots of other really exciting technologies that could come in that could really help complement Bitcoin. You know, Bitcoin was born through the internet. And the internet is something that's growing very rapidly. And I think that's what, in some way, gives Bitcoin its growth exposure. That's something that gold doesn't have. It's a bit like basically gold with a growth component on it in some ways.
So let's then move on to the buying interest in both Bitcoin and gold. Is the same investor buying Bitcoin as the one that's investing in gold? I mean, where are you seeing their interest? We've obviously all read about Tesla, and we'll sort of move on to Tesla a little bit later under the ESG agenda, perhaps. I'd just like to get your thoughts. Where is this interest coming from? And where do you see the investment banks positioning themselves as far as Bitcoin is concerned?
Can I answer this one first?
Please, I want that one.
I mean, you both get the opportunity. So
I think
yeah.
A year ago, it was more speculative. This is something interesting that we might buy, but the biggest change in mindset amongst investors is concern of loose monetary policy and how they deal with that. And there's a hunt for hard assets. Now, gold gives you that option. It is one of those options. Maybe the Swiss franc. You can't really, it's not really the yen anymore. And I think Bitcoin is just one of the small group of liquid hard assets that you can buy. And I think that is what investors, now, as they understand Bitcoin better, are starting to, is one of the key rationales as to why they're buying Bitcoin.
I think that Bitcoin has been very much driven by retail money until recently. The institutions, as I said earlier, have woken up in the last few months, and that's a good thing. They deserve to be here. It's here to stay. I don't like the current hype cycle, but it's here to stay, and I'm a long-term bull on Bitcoin. Be clear about that. But I think Dan Capiera, who's a sort of New York financial bit of a financial legend and very close to the gold market, he made a very good point about Bitcoin taking over gold. That the institutional investors, you know, still haven't picked up gold yet in most cases. And so, let alone Bitcoin, you know, forget it. It's not happening anytime soon for this thing to go mainstream in finance, when most pension funds, for example, do not own gold yet. Now, I remember working at HSBC in the beginning of the century. God, that makes me sound old, but it was difficult to put gold in portfolios, even when the ETF turned up, because people looked at you strangely. It was considered an odd thing to do, to put this piece of metal in the portfolios. And of course, gold has been the best performing major asset this century, excluding Bitcoin, of course. You know, it's beaten all the major equity indices. It's beaten other commodities and the bond market and so on. And despite that, it's still seen as, you know, as not a credible hard asset in many circles in the mainstream. Wealth managers own it, but pension funds don't. And so if you haven't won the argument on gold yet, then good luck with winning the argument with Bitcoin to the big institutional money anytime soon. So
it'll always polarize opinion, won't it? I mean, I think gold will always polarize opinion, and I think Bitcoin will always be the same. You'll always get some people who say it's absolute rubbish, I'd never have it in a portfolio, it doesn't yield anything. And you can apply the same argument to both. Totally.
And the other obvious point is age. You know, the kids naturally tend towards Bitcoin, and the grey hairs naturally tend towards gold. But you'd be amazed how many smart 70-something-year-olds there are out there who have got a lot of Bitcoin and have been there and get this. So I don't think we want to be ageist about this. There's probably more Bitcoins held in people over 40 than under 40, I would think.
I mean, on that note, and I slightly sidetrack, you've got this digital gold, gold tokenization, which could potentially appeal to the younger generation. Do you think there is some merit in that? I mean, digital gold.
I do. I mean, I think the younger generation see value in intangible digital things. My son I caught trying to buy $100 skin for his first-person shooter game, which I just think is absolutely ludicrous waste of money. But I do think digital natives, not digital immigrants like most of us are, see digital things, digital assets in a different way. And that's a mentality I think a lot of us struggle with, but I think it's something that's happening. And that's why I think the younger generation are much more accepting of Bitcoin and other digital assets.
So we go back to the birth of the internet in the 90s, and that the internet didn't do much that was good for society at that time, but most of us got the picture, and the stock market certainly did, and went nuts. Most of those investments didn't work out. I mean, Amazon carried on, but most didn't. And it's the same creative destruction cycle we're seeing here. And that's no bad thing. It's actually the history works best that way, because you want to be able to find the solution as quickly as possible. If you have the government deciding how the internet works, it really won't work out too well. Where if you let the Wild West just have a go and let the winners thrive and the losers die, then the whole thing works out well, and you come up with the best solutions. So the younger generation just totally get this. And in the same way the internet was a good idea, but not particularly useful in the 90s, now it's a really good idea and really, really useful. And we're at the early stage of exchanging value rather than just information and online services. And value can be in James's son's electric sword on a computing game. It could be a piece of digital art that changed hands for over $300,000 through Christie's recently, or it could be there are virtual sort of towns where you can go and buy an apartment with a view online. It doesn't actually exist, you can't visit it, but it's there on the internet, and these are changing hands for tens of thousands of dollars. So there's a very different view out there by the millennial generation who and the one after that who just think it's it's entirely normal that the internet is a piece of real estate that's going to be here forever, and go and buy your piece of it. Crypto is really just an extension of that idea, whereas where you can actually transfer value across the internet without a central party, and it's a very, very strong, very, very beautiful and sustainable idea. How it shapes out in 10 years' time is anyone's guess, but that's the direction of travel, exchanging value over the internet.
So I'm just going to pause there. If there's any questions from the audience, please do send them through the chat. Otherwise, I will continue to ask. Okay, actually, I do have a question. So what is your view as fair market value for a Bitcoin? Should we start with James?
I think you have to bear in mind that Bitcoin is very volatile, unlikely to be for quite some time. Part of the reason historically why it had 200% annualized volatility was due to the fact that as Bitcoin was being born, so were all those 300 plus exchanges that were creating price discovery being born too, with a very, very eclectic set of investors. But but that will subside over time, the volatility. But bear in mind, when you think about some sort of price target or fair value, you've also got to apply a health warning to Bitcoin, and in the near term, that's not going to change. That said, I have to think personally about the fundamentals behind what's driving the Bitcoin rally, and in my mind, it's people are looking for a hard asset. And if you look at other equivalent hard assets out there, such as gold, if you looked at the total amount of gold, for instance, in circulation, investable circulation, so that's not central banks or jewelry, it would, if you said Bitcoin could reach that equivalence, then that would equate to a price target around 150,000. Might sound ludicrous to you, but that's, in terms of total gold above ground, that would equate to around 25%. And when you think about it in that respect, when you start to understand that it is this very hard asset, I don't think it's quite a crazy thing. And recent price moves, some people believe is a big bubble. Personally, I don't. I think we are seeing increasing adoption, which is perversely a bit of a self-fulfilling prophecy, which if gold was created today, it would be the same thing. The more and more people see it as a store of value, and so it becomes one. So yeah, think about that. A 10% of gold of total gold in circulation would equate to around a price of around 60,000. We're starting to see that happen.
So I think when you try and value, well, let's do gold first, that's easy. So I'm looking live at my at the Morris Gold Fair Value model, and based on a 20-year tip, the price of gold is $1,780, and the fair value is $1,795. So you can buy cheap gold today, ladies and gentlemen, 1% below fair value, according to my model. Now, I put a similar thesis into Bitcoin. Obviously, it doesn't trade off the bond market, so we had to use different metrics. And I divide Bitcoin valuation into primary and secondary. So primary is really looking at imagine Bitcoin's a company, and it's doing a cap raise every single day. When the miners sell new Bitcoins, that's effectively a company going out to market and raising capital each day. Yeah? Now, the miners are going to sell 1 million Bitcoins between now and a little over 1 million Bitcoins between now and the next halving period in 2024. May 2024, probably end up being April. It's always early. And so at $50,000 Bitcoin, 1 million coins, I'm just rounding the numbers here to make it simple, Bitcoin needs to see $50 billion of inflow over the next 3 years and 2 months. Okay. Now, if you think that's easy to do, then 50,000 is fine. If you think that 200,000 is easy to do, then times that by 4. It's now $200 billion of inflow is required, which, by the way, is more than the gold market's had since 2002 into the gold ETFs. So that they're worth that, but the flows were lower than that. So if you think that's possible, then you can go to high numbers. But I would remind people that to see $50 billion come in the next 3 years and 2 months is a tall order, particularly when the inflows since the last halving have been about $5.5 billion. So, on that basis, I'd be much more comfortable saying the average price over the next 3 years of Bitcoin will look more like 20K than 50K or 300K. That's not to say there couldn't be a spike to 300K, because in a hype cycle, anything is possible. But I'm not interested in that. I'm much more interested in the average price over the next 3 years. Now, my second valuation methodology will be the secondary market. And the secondary market is, how dynamic is the network relative to how it's priced. And ByteTree.com, you can see there, the information's there, we publish it, you can see each block coming through and all the rest of it, and the analysis of that data. And that puts a fair value of the network of just below $30,000 Bitcoin. So the secondary market valuation would come to $30,000. And the primary market would say, yeah, fine, 50K is great, provided you can see $50 billion coming over the next 3 years and 2 months. That number comes down to 30 billion if you have an average price of 30K.
Great. Thank you for that. I'm getting quite a few questions, actually. So I may just ask the panelists if the answers could be kept a bit brief. I do want to touch on one more subject, and that's ESG as well. And we have 15 minutes to wrap all this up. So I'm going to first do a quick fire round with the questions. The next question is, I'm just going to read it verbatim. I'm sure that many people in the 17th century thought that tulip bulbs were the new gold. Is Bitcoin just a digital version of tulip bulbs? James?
History's telling us no. I mean, I'll be quick on this one. Tulips, the whole bubble lasted around 6 to 9 months. Bitcoin's been around 12 years and has had, and I have ridden many ups and downs in this period. I think just by that very definition, it's very hard to call a bubble. Most bubbles sort of rise once, pop, and then they're done. Bitcoin's been around, and I think in this emergence in new asset class, that volatility is because people don't fully understand it yet, not because it's a bubble.
I think Bitcoin, if it is a bubble, it's more like Amazon 1999, which, by the way, worked out quite well. And by the way, tulips didn't work out too badly either, because Amsterdam is I think, still the world's center of the flower trade. So they got something out of that. No, it's not a tulip mania story at all. I understand why a lot of people think that, but I think if they study it a little bit harder, then they hopefully might change their mind.
The next question is perhaps focusing more on the challenges or perhaps the concerns around Bitcoin and crypto generally. And this is issues like money laundering, the audit and the ownership as far as Bitcoin is concerned. I'm sure we could dedicate a whole session to this question, but again, 30-second view. Charlie, do you have something to say on this point?
Yeah.
Understanding it's a big topic.
Sure. I mean, I think that for most people who see Bitcoin as an investment and are not in the tech space, I'm obviously in asset management, Bitcoin asset management. So, but products do take away a lot of the risks, because you can lose your keys and all the rest of it. I think you need to be very, very careful about doing it yourself, unless you're dealing with small numbers, or you've got some competence next to you. There's no help center, there's no helpline if things go wrong. So use credible providers is my advice.
James,
yeah, for me, about the money laundering point, there's a really good report by Chainalysis. It came out last night, highlighting that around 1% of Bitcoin usage, that's around $10 billion a year, is used for criminal proceeds. So that's actually very low. If you look at Europol came up with a stat saying around 30% of euros in circulation were being used for money laundering. So on a relative basis, actually, Bitcoin is much, much less. It's quite high profile though. A lot of scammers are using it, but it's relatively a very small amount. And in fact, not a great place to be a criminal. The addresses are in an immutable public ledger, which everyone can see. So let's say if you could scam someone, you have to give them your Bitcoin address. And as soon as you have that, you can track exactly where that goes. And the FBI have been very successful, and other law enforcement agencies, at tracking down those criminals.
Yeah, just to very quickly add to that, the ByteTree.com tracks Bitcoins, and it's not difficult to do this job at all. So you're a bit of a monkey if you're using Bitcoin for criminal activity. I recommend you use large euro notes.
The next question. So what do you guys think that China starting its own digital currency will affect the flows into gold and Bitcoin in the short term or medium term? What do you think?
Yeah. So that what they're alluding to is central bank digital currencies, or some people call them CBDCs. Now, 80% of central banks around the world now, according to the BIS, are engaging in CBDCs projects, and China's just launched one. It's a trial at the moment, but it could be successful. There have been a few trials that were abandoned a few years ago from some countries, but they could well be successful. I think they represent something incredibly different to Bitcoin, though. Ultimately, they will reflect the fiat currency that they represent and not much else. Also, it will be they will, I'm sure, really help make accountancy processes and settlement processes much more efficient. It'll also help the government track exactly what you'll spend your money on. And also, they will be able to control what you spend your money on too. So there's a lot of potential civil liberty issues, which, by the way, very much suit China in that respect, but I think will be harder to implement in the developed world.
I can add a tiny bit to what James said, who gave an excellent answer to that, and that is it's an influence here as well. So if China can get their money into other countries and be widely owned around the world, then that increases Chinese influence, generally speaking. And I think that countries that don't digitize and get their money out there will see the need for the demand for their currency wane over time outside their own country, which would be a bad thing. So maybe that leads to a world of fewer bigger currencies, but certainly there's a geopolitical impact there. But yes, it's very, governments love it. It's a snooping tool. It's fiat money, same old fiat, but on better payment rails.
I'm going to ask one last question from the audience. I mean, I still have lots, but I want to ask my ESG point as well. So the final question, do you feel gold and Bitcoin are undervalued or overvalued at today's prices?
Well, gold's 1% undervalued and Bitcoin's about 50% overvalued.
James, do you have a view?
It depends on your time horizon. If you're looking out for 2, 3, 5 years, then it's undervalued.
Oh, can I give the 10-year view? And I wrote a piece a year ago, gold, you only need to have 4% inflation expectations, and the gold price is about $7,000 by the end of the decade. And Bitcoin, you know, I'm very much in the $500,000 camp by that time.
I mean, yeah, and this is the point. This is something, it's not a core scenario that the world has hyperinflation, but you have gold in your portfolio for a tail risk. And I think Bitcoin is the same thing. You have it in there for a tail risk, a what if scenario.
There's a few questions which is comparing or asking for your views in terms of Bitcoin and comparing it to some of the other digital currencies, but I'm going to park those questions and come back to ESG and Bitcoin. Now, you know, Tesla, I mentioned Tesla earlier on, added a lot of Bitcoin to their balance sheet. There was potentially some criticism that is Tesla buying, compromising their ESG objective. Is Bitcoin terrible for the environment? Your views as to where Bitcoin, and you know, I think we understand the ESG agenda as far as gold is concerned, but where do you think Bitcoin sits on that scale?
Can I take the Tesla bit? And I think James has got a strong answer on the ESG bit, which we were talking about before the interview. So on the Tesla bit, you know, about 2 or 3 weeks ago, they announced a $1.5 billion investment. And that's made them some money. I think they paid, I must have been around 32,000, but I don't think they disclosed the price. And so they've made some money. The joke is they've made just under $1 billion, which is more than they've ever made out of cars. But the you know, Tesla's like the 5th biggest company in the S&P 500 now, and so it's very different for a smaller company like MicroStrategy to do it, and a very, very large company that's owned by every index fund on earth pretty much. And the impact on Tesla, as at yesterday midday, was $100 billion has come off Tesla's market cap since the day after the announcement. 100 billion. Wow. I don't know what that means. I don't know if that's it means that the ESG indices will think twice. Maybe it impacts their emission credits or their brand in certain circles. I don't know, but I'm just saying that since the announcement 2 or 3 weeks ago, that's a lot of money to come off your valuation.
So in my mind, I feel this is a bit of the woke brigade's agenda. I might rile a few people saying that, but I think the first thing to understand that Bitcoin is its energy usage is a feature, not a bug. And essentially, part of what makes gold valuable is the fact that you've had to expend a lot of energy to get it out of the ground or find it. And I think it's the same with Bitcoin. It's designed to expend energy to make it actually worth something. And actually, energy usage, if you look at any sort of any money, it's technology, whether that's seashells or gold or any sort of physical coin, represents a technology of some extent, and including fiat for that matter. So you have to, and technology expends energy, and so Bitcoin is just one of those other things that. And I look at it in a good way. Energy consumption and GDP are closely correlated. So the more energy you spend, the better it is for growth. But just looking at the sort of top level numbers, if you look at Bitcoin's energy usage, it's around 78 terawatts per year. If you look at data centers around the world, by the way, Bitcoin is a very easy thing to single out. You can't go and ask YouTube how much you spending on electricity every year. They're quite happy not to tell you that. And the same with Netflix and others. If you look online, you won't find the numbers. But you can look at global data centers, and they use 200, more than double that of Bitcoin. They use 200 terawatt hours per year. And I think this is a bit of a disingenuous argument because partly Bitcoin is mined in many places where there's excess renewable energy, such as the new hydroelectric plants in China where they're overspec'd and producing too much electricity. So a lot of it is sourced, around 65 to 70% is sourced from renewables. And so it's not, the environmental impact isn't quite as bad as many think, but this is something that many people around the internet have got their hooks into and believe it's true. And I think it's a bit disingenuous. You buy an electric car, you're plugging it into a grid that is probably producing carbon dioxide. So it's not quite, if everything was renewable and it's sourced from renewable energy, Bitcoin would be 100% clean too.
I'd like to just take that one again, if you don't mind. And the GDP point's the most important thing. I mean, the reason we live in a civilized world that we do is because we consume energy. And people who want to consume less energy want to have less economy. They want to have fewer jobs. They want to go backwards on living standards. And there's no way it's fair for some countries to have nice lives and for emerging countries to have lesser lives. And I think that's deeply immoral. And we've got to consume more energy if we want to progress as mankind. The challenge is to get cheap and green energy over the long term. And that's what we should be doing, getting more of it rather than just trying to reduce consumption. Productive ways to consume energy is how we improve our lives. So the question is, do you think that Bitcoin is productive? And James and I clearly do. Do you think Netflix is productive? Well, you're probably sitting on the sofa whilst you're watching it, but yes, it's made our lives better. So how we use energy is probably a more important point, and we definitely need more of it in the future.
Great, well, thank you. And with only a couple of minutes to left, I mean, we have run 15 minutes over, but that's okay. It's been a really interesting, insightful discussion. So thank you both to Charlie and James. But I just want to wrap up. So literally a minute each, James and Charlie. What is the future? What does the future look like as far as gold and Bitcoin is concerned? Starting with you, Charlie.
Yeah, so I think it's a really interesting portfolio allocation. I think that if you don't own gold, then you should own gold, and that's not a recommendation. That's a thought. And if you own gold, you should own a little bit more gold going into the era we're going into. And if you don't own Bitcoin, you might consider it. If you own too much Bitcoin, you might consider balancing against gold. I think these two are going to work together and give you a really good, strong journey over the next decade.
James?
I wrote an article a little while ago now called "Little Bitcoin Goes a Long Way." You only need a very small proportion of portfolio to really make a demonstrable positive impact, even on a risk-adjusted basis. So I think that's one thing. The other thing to remember is that Bitcoin, we're witnessing the birth of a new asset class, and how often in your career do you see that? It's never really. And if you invest into it, expect volatility, but we're only now, I think, just at the early stages of institutional adoption of Bitcoin, and that's likely to be supportive of price.
Great, well, thank you so much. I certainly learned a lot. Apologies to those that did ask questions, but I never got around to asking. I will say that we do have a fourth digital gold scheduled in for the end of March, where we're going to be sort of focusing more on the payments angle. Can it be used as a payment tool later on? I mean, Bitcoin has certainly, started to sort of be used as a payment vehicle. Can digital gold be also a payment vehicle? So please do reconnect. That's the third week of March. Otherwise, I'm going to hand over to Taylor to talk us through any other upcoming webinars.
Thank you, Sakhila, and thank you to Charlie and James for joining us, and apologies for the technical issues I had earlier in the webinar. Sakhila's right, we do have a lovely schedule coming up. Next week we have a webinar with NASDAQ on LBMA trade data. So that's a very technical kind of guide into how, when and where to access the data, and you'll get a live kind of demo on how to use that on the Bloomberg terminal. So that's going to be really great for you if that's something in your area of expertise, or perhaps not in your area of expertise. In March, on the 4th, we have a webinar, The Chinese Gold Market in the Year of the Ox. So we have Jeremy East, Johnny Tevers of UBS, and Roland Wong of World Gold Council to provide an update for you. And the 18th is highlights of LBMA's 9th Assaying and Refining Conference, which is coming up. It's in less than 4 weeks. So if you're not registered, you should get along and register to that. And then following this, it wouldn't quite fit on the page, but we have the next Digital Gold webinar. So stay tuned for more details on that. We hope you can join us. And if you do have any questions, please email us at ask@lbma.org.uk or follow us on any of our social media platforms where we post regular updates. That's a final thank you from me. And again, thank you to our speakers.
Thank you.
Thank you.
Thank you very much.